Hello, everybody, and welcome to the Like a Totas report. Happy Monday. I'm recording this on Monday, February the 16th, but I will be posting this tomorrow, the 17th. And today, I want to break down exactly the upcoming earnings report of Alibaba, and I will be showing you exactly what I'm after ahead of that earnings report, what I would like to see, right? What would be the best case scenario. And this will also coincide with what analysts are expecting to see in that report in conference call. Okay, so the major behemoths in the United States have already reported, companies from Microsoft, Amazon, and so forth. They are all spending a ton of money on AI data centers, right? GPUs and so on. And so it's going to be very interesting to see if Alibaba, which has been following in their footsteps, right? Because they all want to be at the forefront of AI. So it's going to be very interesting to see if Alibaba is once again ramping up capex, and if profitability has taken a significant hit. All right, guys. But before we delve deeper into it, let's discuss our next YouTube live event, which takes place on February the 27th. So we're just a few days away from it. So today is the 16th. The event will happen on the 27th. That means it's Friday next week. So, guys, in the last one, we had 25 people joining. Make sure that you tune in to make sure that you can ask any questions that you may want, personal questions, stock market related questions. This is a great time for me to actually get to know who you guys are, okay? And some of you guys were joined in the last two calls, and I just love the experience, which is why I want to continue to do this as well. And it's a way for me to say thank you, right, and to show my gratitude for all the support that you guys have been showing for the channel. And sure enough, we are over 400 subscribers right now. It continues to grow every single week, so I'm definitely happy for that. Okay, thought of the week. Let's start our Monday with a great post that was created. So, as you guys know, Pallavi is working with me. I've already mentioned a work for the company in a few videos ago, and she's very active across social media. And hopefully, she's managing to get the word out, right? So we can have more people following Like a Tortoise, and hopefully, we will all have them make better decisions with their hard-earned money. But sure enough, let's see what she says right here. This is a great post once again. The high earner paradox: excelling at earnings income but stagnant in net worth. True story. Earning a six-figure paycheck is a skill. Compounding that paycheck into a sustainable wealth engine is a completely different discipline. Most people lose the game because of stomach, not intelligence. As Peter Lynch famously said, they react to the noise and sell during drawdowns. As an investment coach, I provide the emotional discipline and the structure system 1 hour a week to move you from shortcuts to fundamental valuation. In fact, many of the messages that I send on LinkedIn emphasize this, really make the case for successful investing in just about 1 hour per week, because that's all you need, guys. That's just about what I devote to my investments on a weekly basis. At least that was certainly the case back then, when I was still working a full-time job as a software engineer, and I didn't have enough time to devote to every single company in my portfolio, so I had to run a concentrated portfolio. I'm also running a concentrated portfolio right now. But the key thing is, the more you understand about a company, the less diversified you need to be. But also, all it takes is really 1 hour per week. And let's be fair. I think if somebody asks you, hey, would you exchange 1 hour of your time per week for 1 hour of your time per week for doubling money every 3 to 4 years, right? Then you would likely say yes. So that's exactly what our framework allows you to do if you really want to be a successful investor, but also go about your day-to-day job. Because let's be fair, not every one of us is interested in studying companies. But this is where I step into your shoes and do a lot of that work, so you can focus on your day-to-day work. Awesome. So the DEY approach is expensive. My portfolio has compounded at 20% plus per year because I follow a strict proven framework. It's time you had a seat at that table Which part are you on? Tortoise Labs. Here we go. Yeah. So yeah, this is every single day. Every time I post, I will sharing the posts that we are creating on social media, so you guys can, and hopefully you guys will find them insightful, and will be able to make notes, right? And this will help you along your investment journey as well, completely free. Just make sure you smash the like button and share the Like a Tortoise channel with people who you think can benefit. And speaking of which, let's start getting these cans and shirts. In fact, I already ordered a few Like a Tortoise shirts, and hopefully you guys will start sending pictures my way as well. And yeah, and here we go, off to the races. Right, everybody. So let's talk about Alibaba upcoming earnings report. That's really what matters here. For those of you who are new to the channel, I I have a free WhatsApp group where I post these PDFs that are quite insightful regarding a company's earnings reports, my takeaways from both the earnings reports and conference calls. And I did that for Alibaba in quarter 3 results. Here we go. The quarter 3 results breakdown. This was November quarter 2025, and I will just give you a rundown of what my of the main takeaways. Right, I will show you exactly what the quarter 3 report showed us, what my takeaways were, and this will set the tone for the rest of the video, because we will be discussing quarter 4 results, which haven't been posted yet, right? But yeah, so it's what I'm after, what I'm looking to see. So as you guys know, Alibaba is my largest holding. I made this company my largest portfolio allocation 2 years ago, when people were calling China uninvestable. Sure enough, uninvestable attracted me quite a bit, especially because when I started buying Alibaba shares, the company was trading at just about book value. So I had a huge margin of safety, given that the company was producing, I think they were generating at the time, they were generating $6 billion in free cash flow every single year, and the company was literally priced for almost bankruptcy. I mean, can you believe that? They were certainly priced as though the company was not going to grow its free cash flows in the next 10 years. So just ridiculous. Okay, so key takeaway in one line: Alibaba is deliberately sacrificing short-term profitability to fund AI infrastructure in instant commerce expansion, and accelerating revenue suggests these investments are beginning to work. Let's have a look at the financial highlights from quarter 3. Look at that. They did report an uptick in revenue growth, right? It was up 5% year over year. Adjusted, look at this, adjusted for disposed businesses. This is the part that really matters, because Sunheart and InTime were businesses that were not generating, well, let's put it that way. They were generating revenue, but they were unprofitable. And so Alibaba decided to sell them. And sure enough, adjusted for the disposal of these two businesses, like for like revenue, right, would have grown plus 15%, a far more accurate reflection of underlying momentum. So this number is the number that I really like to see. These disposals helped fund strategic reinvestments into AI and cloud infrastructure. Now, profitability pressure. Yes, revenue grew attractively, but at what costs? Well, at the cost of profitability pressure. What do I mean by that? I mean, take a look at these scary numbers, and they were, if you didn't understand the company's story, and why these numbers are negative as they are, right? So the following declines are largely the result of heavy strategic reinvestment. Income from operations was down a staggering 85%. So was adjusted EBITDA, net income, non-GAAP net income. Everything was sharply in the red, as you can see. And look at margins. So margins, operating margin was 8% versus 15% last year, because profitability took a hit. Of course, margins compressed as well. And we can see that, right, relative to last year, same quarter last year. Cash flow in CapEx, net cash from operations took a tumble, minus 68%. Free cash flow was negative 21.8 billion RMBs. And sure enough, if I go here to our stock analysis platform, And you guys know that I use stock analysis, and I'm not a subscriber, so this is completely free. You guys can all have access to this. But if I go here to the quarterly segment, right, cash flows, you can see that free cash flow was negative in the last quarter. Why was that the case? Because they are investing quite a bit. All right, just once again to remain competitive. They are facing a lot of competition in China, but they are hitting that competition for lunch, which is something that I really like. And let's be fair, not every company has the free cash flow power that Alibaba boasts, and this gives them a lot of firepower, right? Which is something that I like to see. And if you look, for example, Meituan, I think that's how you pronounce it, they are facing a lot of pressure from Alibaba and even losing market share. So yeah, that tells you something. Right, so let's continue. This deterioration reflects aggressive AI infrastructure and instant commerce investments. Cost pressures, right? Look at that. Sales and marketing rose 26.6%, right, of revenue versus only 13.5%. They are spending more on marketing campaigns, and also possibly even wages as well, driven by increased user acquisition and improved experience investments across China e-commerce. These ugly numbers represent deliberate strategic reinvestment, not structural weakness. Share-based compensation continues to decrease, which is something that I really like to see. And as I already mentioned in previous videos, they are now using more cash incentives, and this is exactly what I want to see as a shareholder, as little dilution as possible. Segment comments, then this is what you see. Look at that. Customer management revenue grew 10%, right? Alibaba International Digital Commerce grew 10%. Cloud Intelligence Group off to the races, 34% year over year, up from 26% growth last year. Adjusted EBITDA increased 35%, right? So very profitable on this measure as well. And AI-related revenue grew triple digits for the ninth consecutive quarter. Very nice to see. So revenue across Alibaba's main business segments is increasing, again because they are also spending a lot more, right? So that is costing profitability in the short term. So this revenue growth is costing them profitability in the short term. I do believe that's not permanent. Okay, it's not structural. And so management commentary. What were the core themes? We are not able to keep pace with demand for AI. User engagement and retention exceeded expectations. I even underlined that, right? And then they also said that capex may exceed prior the 380 billion RMB guidance, exactly because they can't meet this exceeding demand, increasing demand. Management is clear. This is an aggressive investment phase. Aimed at long-term dominance. Okay, of course, the capex spend really caused some investors to be concerned, right? Because we are not seeing profitability right now. But remember that this is similar to what's happening in Western countries, namely the US, where we are seeing all these guys like Meta, right? Amazon, Microsoft spending a ton, even ramping up capex, right? Committing several billions of dollars to AI infrastructure, and with no returns in sight. All right. And the main difference is that, as we will see, the valuation of Alibaba is still very compelling, certainly relative to these AI oriented businesses. So, okay, this is what we see, right? And now let's tell you everything you need to know about the upcoming quarter four earnings report and conference call. What I'm eyeing in particular. As always, I will be sharing this PDF in our free WhatsApp group and school community. So if you guys haven't joined yet, by all means, just let me know and I will add you to them as well. Awesome. Can Alibaba balance growth with profitability? Okay, I want to see exactly what this looks like in this quarter, even though, look, I'm not expecting a meaningful change from past quarter, right? Because So Alibaba is preparing to report its quarter four earnings at a critical junction after a strong near 48% share price rally over the last 12 months. Let's confirm that. Take a look at this, right? So the last time we discussed Alibaba was around, when did that happen? Was around November. Yeah, so that was around these levels right here. So the stock hasn't changed that much, but look at the difference from the lows that were set right here in 14th of November to where we are right now. That's a staggering 160% jump, right? So okay, despite several mixed headline results, investors are now looking for confirmation that Baba's transformation into an AI-enabled commerce and cloud platform is translating into durable revenue growth without permanently impairing profitability, which is probably the main focus for this report, right? We already know that Alibaba is going to continue to spend on AI initiatives and of course at home as well to keep e-commerce competitive. But the question is that growth gonna be at cost at net, so at does that growth mean compressed margins, right? So profitability under pressure. That's what we will find out. This earnings release will be less about short-term margins and far more about direction, discipline, and monetization traction. Big picture in one line. Quarter four earnings will test whether accelerating cloud and AI growth can coexist with margin stabilization or whether investment intensity continues to outpace monetization. Look, in all fairness, guys, I would love to see this, right? I want to see that yes, the acceleration is can actually coexist with margin stabilization, at least stabilization, not least improvement. But I wouldn't be surprised that this quarter shows us further pressure on profitability. Um, but we will see. Only time will tell. Earnings expectations. So, what's the consensus? You can see that analysts are also expecting the same. Take a look at this. Analysts expect higher revenue but lower profitability compared with both last year and recent quarters, reflecting continued heavy investment, which means that expectations going into these earnings reports are not very high. Look at that. So, revenue is expected to grow 3.9% quarter over quarter, right? Quarter on quarter. Pre-tax profit is expected to actually decline to 44% year over year, and earnings per share is actually expected to decline 42% year over year. So the market is already pricing in earnings pressure. That's why I mentioned this here. The key question is whether revenue quality and growth mix justified, right? So any upbeat on so any if they go on to deliver above earnings if they go on to deliver so above pre-tax profit relative to expectations, then you can see a rally on that, on the back of that. Okay, so I like to see, many times we see that analysts are exuberant going into earnings. This is certainly not the case for Alibaba, and it shouldn't be. It shouldn't be, because I've been invested in Baba for 2 years, and I can't really think of any quarter where Baba really blew past analyst expectations. So the cautious tone is warranted, right? But once again, this creates room for upside potential in case they exceed those expectations. What the market is really watching, again, revenue mix, quality over quantity. Investors are increasingly focused on where growth is coming from, not just how much growth. Is revenue continuing to shift towards AI, cloud, and international commerce? Are lower margin legacy segments becoming less dominant? Is top line acceleration sustainable without excessive incentives or subsidies? In recent quarters, headline revenue growth, 5% year over year, as we discussed, understated the true momentum in Alibaba's growth engines. Okay, so pay attention to that. Also, cloud and AI will be front and center, the center of gravity, right? So the cloud intelligence group remains the cornerstone of the long-term thesis. This once again will be highly scrutinized because investors want to see continued acceleration in demand for the products here. From prior quarters, you can see that cloud revenue growth was 34-35% year over year. AI related revenue triple digit growth for 9 consecutive quarters. I expect this to continue again, which will mark the 10th consecutive quarter of triple digit growth. What investors will focus on this quarter? Signs of AI monetization, right? So far, it's been just usage, but what are they telling about AI monetization, if anything? External non-Alibaba ecosystem, customer adoption, margin trajectory as scale improves, commentary on capacity expansion versus returns on invested capital. I will be, and I'm pretty sure that analysts will be asking the question if they don't mention about returns on invested capital throughout the earnings call. I'm pretty sure in the conference call, analysts will bring this to their attention, and they should. And they should ask something like, hey guys, you are spending this much on capex. When are you expecting to see significant returns on capital, right? Do you already have that insight? So we want to see that. Can Baba keep scaling AI without free cash flow deteriorating further? Remember, it was negative last quarter. That is everything we will need to know on the AI front, AI and cloud front. What about the commerce front, which remains, of course, the cash engine? And they are fueling a lot of this growth from the money they generate from this segment, which is by far the most profitable one. Well, it's certainly by far the one that contributes the most to the profitability, right? While cloud captures the narrative, e-commerce remains financially decisive. Key areas under scrutiny will be Taobao and Tmall, right? Gross merchandise value trends. Merchant take rates, are they increasing or are they declining? We need to pay attention to that. Effectiveness of AI-driven marketing tools. Impact of loyalty programs on retention and spend. Is the retention going up or down? Yeah, we need to understand that. If it's going up, it means that the platform is becoming more sticky. We want to see that, right? Because then they will be able to raise prices without that costing um, um, customer loss. Competitive positioning versus JD and PDD holdings. China's consumer environment remains uneven, making execution quality more important than macro tailwinds. Cost discipline versus strategic spend. Alibaba has been explicit. Profitability is not the short term priority, and it shouldn't be. This is a company, and guys, you know that I like to see profitability in a company. I want to be clear on that. But what you guys also know, if you are following me for a while, is that when the company has a lot of reinvestment opportunities, right? Like Amazon like Amazon since its inception, then it makes sense for them to it makes sense for profitability to be lower if they are reinvesting strategically. And for example, a terrible metric for us to pay attention to when evaluating a company like Amazon is free cash flow. And you can see that a company like Amazon has free cash flow that is much lower compared to net income. Why is that? Because they are always reinvesting into the business. They have plenty of opportunities to reinvest back into growth, and that's what they do. And many times we see that costing them profitability in the short term, but it's a great thing to happen because over time that should be able to lead to more market share. Okay, and that's what I expect from a company like Baba as well. Right. Investors will listen closely for updated capex guidance. Is it going up or down? We want to see that. Management's confidence in margin normalization during H2 2026. Whether spending intensity is peaking or still accelerating. Remember that they mentioned that capex might still increase. We want to hear them we want to hear them say something about that. Evidence that incremental investment is generating operational leverage. In other words, they are spending so much, right, on capex they are spending so much on AI initiatives and so forth. Are we seeing some efficiencies across their ecosystems now that they are implementing a lot of this innovation, right, across the business segments? If so, what that does is it can ultimately lead to operational leverage, right? And we want to see that. We want to see the company becoming more efficient over time. Now that they are spending so much on AI related products, and this should be integrated smoothly across their business segments and drive efficiencies. This quarter could shape expectations for when earnings power re-emerges. Cash flow and balance sheet strength. Recent quarters showed investment-led free cash flow outflows, right? We can see that. Look at that. If I go here to the company, look at the investing cash flow for Alibaba. Look at that. So we can see that cash from operating activities last quarter was around 23 billion right here. And look at the cash flows, look at the cash outflows. It's negative, so it's actually cash outflows about 70 billion, right? Let's continue. What matters now? Liquidity position in balance sheet, whether cash burn is temporary and targeted, right? Management stands on shareholders' returns and reinvestments. Markets increasingly reward sustainable earnings and disciplined capital allocation, not just growth narratives. And this is important, guys. This is very important because remember what happened to companies like Microsoft and Amazon after reporting this quarter, right? The stock of these two companies has come down on the back of capex, um, on the back of capex increases. So the companies, they were guiding for higher capex spend, which actually spook investors, which caused the stock prices of these companies to come down, exactly because they can't tell when profits will be appearing, right? And so investors are now vigilant about these matters. They want to see, come on, I mean, are you really when are you going to show us some profits here, right? So we want to pay attention to that. But again, unlike its Western peers, the valuation is much more attractive, right? Going so because those companies were into earnings at nosebleed valuation levels. Certainly, Microsoft, for an example, was trading well above 30 times earnings, right? 30 times earnings. So the company was literally priced for perfection, and which, of course, because it wasn't meant, that perfection wasn't meant, the stock was under pressure after earnings. And so far, the Microsoft is down almost 30% from its highs. It's not every week you see Microsoft down by this much. But anyway, let's continue. Valuation context, here we are, let's discuss that. Despite its transformation, Alibaba trades at a valuation that still implies skepticism below global AI and cloud peers. This count reflects geopolitical, regulatory, and execution risks. Upside depends on proof of monetization, not wisdom. I agree that Alibaba deserves to be traded more conservatively relative to its Western peers. However, I do think there is room for multiple expansion considering current levels. All right. So take a look at this. You can see the current P is about 21 times. The forward P is about 22 times. But remember that this is misleading given the fact that the company's profitability has been significantly under pressure. So you can't take this at heart, right? Because it's misleading. Again, the company's profits are plummeting. If I show you net income, take a look at this. On a trailing 12 months basis, look at revenues, okay, going up, but look at net income. Look at net income. Look at this, net income, okay? So it's under a pressure. If I show you on a quarterly basis, then you will see the difference. Look, Look at this. Look at this decline. All right. And if I show you operating income, look at this massive decline, right? Given all the operating expenses they've had, especially around selling, general, and administrative expenses. Take a look at this. Look at that. Look at this explosion right here. Boom. In research and development as well. Boom. Okay. Awesome. Okay, so let's move on. Analyst consensus, they are rating the company with a buy. As you can see, average long-term price target sits at about $198 a share. Talk about opinion follows trend. I mean, it's unbelievable, right? These analysts, for example, at Goldman Sachs, in Morgan Stanley, and JP Morgan, that were downgrading Baba at $50 a share, at 60 and $54 a share, are now upgrading the company at $155 a share. You can't make this stuff up. And now they are guiding for $200 a share. At least that's the short term price target, right? Look at that, around $200 a share. We will see if that happens. If that is the case, then the implied upside is about 20% from current levels. Okay. But anyway, yeah, it's what it is. This earnings report is not about headline earnings per share, beats or misses. What I care about most, cloud and revenue momentum. I want to see this continue. Monetization signals, do they talk about pricing power or enterprise adoption? Revenue mix improvement, management discipline on spending, even though I think it's going to be hard to see that, but at least if we get a hint at least if we get a hint at discipline in the next quarters, that will be helpful already. Clarity on margin recovery, this is going to be important as well, right? Do they talk about margin improvement? I'm pretty sure again that analysts will ask all of these questions, so I will keep you guys posted, because after they report the earnings and I listen to the conference call, I will create a YouTube video on the main takeaways from that call in earnings report. Bottom line, Alibaba's quarter four earnings will help answer a pivotal question. Is this a company investing for optionality or one beginning to convert scale into sustainable earnings power? For long-term patient investors, this release is about trajectory, not perfection. The AI transition is real. The valuation remains compelling. Now the company must show it can still balance ambition with returns. Okay, guys, I hope you have managed to learn from today's video. As always, dear subscribers and viewers, I will keep you all posted. I'm very much looking forward to these reports. Again, I don't know if it will be posted on or this week on the 19th, or if they will reschedule the release. But regardless, I will always keep you posted, and I'm looking forward to it, not least because Alibaba remains my largest portfolio position, and also it's been it's been one of the key reasons why the portfolio has outperformed the S&P over the last 2 years, or over the last two plus years, right? I run a concentrated portfolio, guys. You already know this, and so my portfolio, unlike many viewers, will be very volatile. I only have 7 companies in that portfolio, and what happens is, even if one company underperforms massively, as we saw with PayPal, for example, the portfolio will be impacted. But I'm not worried about that, not in the slightest, because I'm a long-term, fundamental-driven investor. I make decisions with the long-term, in mind, and I do think these companies in my portfolio are still quality businesses, and they will all grow from current levels. Okay, so guys, let me know in the comments below if you like this video, and yeah, let me know. Are you eyeing Alibaba? What are you looking for specifically? Have you sold have you sold out of your position? Let me know, and stay tuned for more. Cheers, guys.